Quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Adaptability in trading is not a soft skill, it is not optional, it is the defining characteristic that separates those who survive from those who eventually disappear. Markets are not static systems. They are dynamic, reflexive, and constantly evolving environments driven by liquidity, policy, incentives, and behavior. What worked yesterday will not necessarily work tomorrow. The trader who fails is not always the one with a bad strategy. It is often the one who refuses to adapt when conditions change. You must begin by accepting a fundamental truth. There is no permanent edge. Every edge decays. Every strategy has a life cycle. Every pattern eventually gets arbitraged, crowded, or invalidated by structural change. This is not a flaw in trading. It is the nature of competitive markets. Your job is not to find something that works forever. Your job is to continuously align your approach with current conditions. Most traders resist this idea. They want stability. They want certainty. They want a fixed system that delivers consistent results regardless of environment. That mindset is incompatible with reality. Markets transition between regimes. Liquidity conditions shift. Volatility expands and contracts. Correlations change. Policy cycles evolve. Adaptability is not about abandoning discipline. It is about evolving within a structured framework. Think of adaptability as controlled evolution. You are not reacting emotionally to every move. You are observing, assessing, and adjusting based on evidence. This distinction is critical. Reactive traders chase noise. Adaptive traders respond to structural change. The difference is discipline. You must also understand that adaptability operates on multiple levels. It is not just about changing strategies. It is about adjusting expectations, risk, positioning, and behavior. A strategy that works in a trending market may fail in a range-bound environment. A risk model that performs well in low volatility may become dangerous in high volatility. Adaptability requires awareness of these shifts. The professional trader does not ask, "Is my strategy good?" The professional asks, "Is my strategy aligned with current conditions?" That question changes everything. It forces continuous evaluation. It removes ego. It introduces flexibility. Adaptability also requires humility. You must accept that the market is always right, not because it is rational, but because it is the reality you are trading. If your model stops working, the problem is not the market. The problem is your alignment with it. This lecture will reshape how you think about evolution in trading. You will move away from rigid systems and towards adaptive frameworks. You will learn how to recognize regime changes, how to adjust without overreacting, and how to build a process that evolves with the market rather than fighting it. To become adaptable, you must first understand why markets change. Markets are driven by participants, and participants are driven by incentives. When incentives shift, behavior changes. When behavior changes, price dynamics change. This is the root of market evolution. Consider monetary policy. When central banks are tightening, liquidity is withdrawn from the system. Risk assets behave differently. Volatility increases. Correlations shift. Strategies that rely on abundant liquidity begin to fail. When policy reverses and liquidity returns, behavior changes again. Adaptability requires recognizing these transitions early. Now consider market structure. Over time, strategies become crowded. When too many participants adopt the same approach, the edge compresses. Execution becomes more competitive. Slippage increases. Returns diminish. Eventually, the strategy stops working. This is not random, it is structural decay. Retail traders often experience this without understanding it. They find a strategy that works, apply it aggressively, then watch it deteriorate. They assume they are doing something wrong. In reality, the environment has changed. The edge has been competed away. Institutional traders anticipate this. They monitor participation. They observe positioning. They track flows. When a strategy becomes crowded, they reduce exposure or adapt. This is proactive adaptability, not reactive. Technological evolution also plays a role. Faster execution, better data, and algorithmic trading have changed how markets behave. Patterns that once existed have disappeared. New patterns have emerged. Adaptability requires staying aligned with these structural changes. Another driver of change is narrative. Markets are influenced by stories. These narratives shape expectations, positioning, and behavior. When narratives shift, markets can reprice rapidly. A trader who is rigid will miss this. A trader who is adaptive will adjust. You must build a habit of asking, what has changed? Not every day, not every trade, but continuously at a structural level. This question forces awareness. It prevents complacency. Adaptability is not about predicting change. It is about recognizing it quickly and adjusting intelligently. The faster you align with new conditions, the more resilient your performance becomes. The biggest mistake traders make when trying to adapt is overreacting. They confuse adaptability with constant change. They abandon strategies after short-term losses. They chase new ideas without understanding whether the underlying environment has actually shifted. This is not adaptability, this is instability. True adaptability is slow, deliberate, and evidence-based. It requires distinguishing between noise and structural change. This is one of the most difficult skills in trading. Losses alone do not justify adaptation. Every strategy has variance. Losing streaks are part of probabilistic outcomes. If you change your approach every time you experience losses, you will never achieve consistency. You will constantly reset your learning curve. You must instead focus on performance relative to expectation. If your results deviate significantly from expected behavior over a meaningful sample size, then you investigate. You do not react immediately. You analyze. Ask yourself key questions. Has volatility changed? Has liquidity shifted? Are correlations different? Is the market trending or ranging differently than before? Are participants behaving differently? These questions help identify whether a real change has occurred. Adaptability requires patience. You must allow enough data to confirm a shift. Acting too early leads to overfitting. Acting too late leads to underperformance. The balance is critical. You also need a structured review process. Without it, adaptability becomes subjective. You rely on emotion rather than data. A structured review forces objectivity. It allows you to measure whether your edge is still present. Another key principle is incremental adjustment. You do not rebuild your entire approach overnight. You make small changes. You test them. You observe results. You refine. This reduces risk and preserves stability. Think of adaptability as steering a ship, not jumping between boats. You adjust direction gradually. You do not abandon the vessel every time conditions change. This disciplined approach ensures that your evolution is controlled, not chaotic. It allows you to remain consistent while still adapting to the market. Adaptability is deeply connected to market regimes. Different regimes require different behaviors. A strategy that thrives in one regime may fail in another. Understanding this relationship is essential. Trending markets reward momentum and breakout strategies. Range-bound markets punish those same approaches. High volatility environments require wider stops and reduced size. Low volatility environments allow tighter risk and more precision. If you apply the same strategy across all regimes, your performance will be inconsistent, not because the strategy is flawed, but because it is misaligned. You must learn to identify regimes early. This involves analyzing volatility, trend strength, macro context, and liquidity conditions. These factors provide a framework for understanding the current environment. Once you identify the regime, you adjust accordingly. This may involve changing your strategy, your time horizon, your position sizing, or your expectations. For example, in high volatility environments, you may reduce size but allow trades more room. In low volatility environments, you may increase frequency but reduce individual trade risk. These adjustments are subtle but powerful. Adaptability at this level is not about finding new strategies. It is about modifying existing ones to fit the environment. This preserves your edge while maintaining flexibility. You must also accept that no single approach will dominate all regimes. Diversification of strategies can enhance adaptability. Different approaches perform in different conditions. By combining them, you create a more resilient portfolio. However, diversification must be intentional. It must be based on understanding how strategies interact with regimes. Random diversification does not create adaptability. Structured diversification does. The goal is not to predict regimes perfectly. The goal is to recognize them quickly and adjust effectively. Psychology plays a critical role in adaptability. Most traders struggle not because they cannot identify change, but because they resist it. They become attached to their methods. They identify with their strategies. This creates rigidity. Ego is the primary obstacle. When a strategy stops working, it challenges your identity. You feel the need to defend it. You rationalize losses. You delay adaptation. This is how drawdowns escalate. You must separate yourself from your methods. Your strategy is a tool, not an identity. If it stops working, you replace or adjust it without emotional resistance. Another psychological barrier is fear. Adapting requires uncertainty. You are moving away from what is familiar. This creates discomfort. Many traders prefer to stay with a failing approach rather than face uncertainty. Professional traders embrace this discomfort. They understand that adaptation is part of the process. They trust their framework, not any single strategy. Discipline is also essential. Adaptability must be systematic. If it becomes emotional, it leads to inconsistency. You must rely on predefined criteria for change. Confidence and humility must coexist. Confidence allows you to execute. Humility allows you to adapt. Without humility, you become rigid. Without confidence, you become reactive. The balance is critical. It allows you to evolve without losing structure. One of the most powerful tools for adaptability is feedback. Markets provide constant feedback through price, volatility, and behavior. Your performance also provides feedback. The key is interpreting it correctly. You must build a feedback loop. Every trade, every outcome, every decision contributes to this loop. You analyze what worked, what did not, and why. Over time, patterns emerge. These patterns reveal whether your approach is aligned with the market. If certain setups consistently underperform, it may indicate a change in conditions. If others improve, it may highlight new opportunities. Feedback must be objective. You cannot filter it through bias. This requires honest self-assessment. It also requires data. Journaling is a critical component. It allows you to track decisions, context, and outcomes. Without records, your memory becomes unreliable. You miss patterns. You misinterpret results. Your review process should focus on process, not just outcome. A losing trade executed correctly is not a failure. A winning trade executed poorly is not a success. This distinction ensures that your feedback is meaningful. Over time, this feedback loop enhances adaptability. You become more aware of changes, you adjust more efficiently, your evolution becomes continuous rather than reactive. Adaptability also requires understanding time horizons. Not all changes occur at the same speed. Some are short-term fluctuations, others are long-term structural shifts. You must differentiate between them. Short-term changes may require tactical adjustments. You modify entries, exits, or timing. Long-term changes may require strategic shifts. You adjust your overall approach. Confusing these leads to poor decisions. If you treat short-term noise as structural change, you overreact. If you ignore long-term shifts, you underperform. You must align your adaptability with your trading horizon. A short-term trader adapts more frequently. A long-term trader adapts less often, but more significantly. This alignment ensures consistency. It prevents unnecessary changes. It also ensures that your adjustments are relevant to your style. Understanding time horizons also helps manage expectations. Not every change requires immediate action. Some require observation. Patience is part of adaptability. Another dimension of adaptability is capital allocation. As conditions change, your allocation should evolve. You do not allocate capital equally across all environments. When your edge is strong, you increase exposure. When it weakens, you reduce it. This dynamic allocation enhances performance and protects capital. This requires confidence in your assessment. You must trust your ability to identify when conditions are favorable. This comes from experience and data. Capital allocation is also linked to opportunity cost. In changing markets, opportunities shift. You must reallocate capital towards areas with higher expected value. Failing to adapt allocation leads to inefficiency. You remain invested in low-quality opportunities while missing better ones. Adaptability at this level is about optimization. It ensures that your capital is always aligned with the best available opportunities. Technology and data play an increasing role in adaptability. Access to information has improved dramatically. Tools for analysis are more advanced. This creates both opportunity and challenge. The opportunity is enhanced insight. You can analyze markets more effectively. You can detect changes earlier. This supports adaptability. The challenge is information overload. Too much data can lead to confusion. You must filter effectively. Focus on what matters. Your framework should guide this filtering. It ensures that your analysis remains structured. It prevents distraction. Technology should enhance your adaptability, not replace it. Tools provide information. You provide judgment. Ultimately, adaptability is about survival and longevity. Markets will continue to evolve. Conditions will continue to change. Your ability to adapt determines your success. You are not building a fixed system. You are building a dynamic process. This process evolves with the market. It learns, adjusts, and improves over time. This is what defines a professional trader. Not the ability to predict, but the ability to adapt. Not the pursuit of certainty, but the management of uncertainty. Adaptability is not a single skill. It is an integrated capability. It combines awareness, discipline, humility, and structure. When these elements come together, you create resilience. And in trading, resilience is everything. Adaptability becomes significantly more powerful when it is embedded into a structured decision-making framework. Without structure, adaptation is inconsistent. With structure, it becomes repeatable and measurable. You must define clear conditions under which you adjust behavior. This removes subjectivity and emotional interference. Start by identifying the core variables that define your trading environment. These typically include volatility, liquidity, trend structure, macro backdrop, and participant positioning. These are not abstract ideas, they are measurable conditions. When these variables shift, your framework should signal that adjustment may be required. For example, you may define a volatility threshold that determines position sizing. If volatility expands beyond a certain level, your framework automatically reduces exposure. This is adaptability without emotion. It is predefined, systematic, and consistent. You can apply the same logic to trend conditions. If your strategy performs best in trending environments, then you define objective criteria for what constitutes a trend. When those conditions are absent, you reduce activity or switch to alternative approaches. The key is pre-commitment. You decide in advance how you will adapt. You do not decide in the moment when pressure is highest. This is what separates professional behavior from reactive behavior. A structured framework also allows you to measure the effectiveness of your adaptations. You can track performance before and after adjustments. This creates a feedback loop that refines your process over time. Without structure, adaptability becomes random. You change things without knowing whether the change was necessary or effective. With structure, every adjustment has a rationale and can be evaluated. This is how you transform adaptability from a vague concept into a professional skill. Another critical aspect of adaptability is recognizing when not to adapt. This may seem counterintuitive, but it is essential. Not every change in the market requires a change in your approach. Over-adaptation is just as dangerous as under-adaptation. Markets are inherently noisy. Prices fluctuate constantly. Short-term behavior often deviates from underlying structure. If you respond to every fluctuation, you lose consistency. You become reactive. You must develop the ability to tolerate noise. This requires confidence in your framework and understanding of variance. You know that your strategy will not perform perfectly in every condition. You accept short-term deviations without changing your approach prematurely. This is where statistical thinking becomes critical. You evaluate performance over a meaningful sample size. You do not judge your strategy based on a small number of trades. This prevents unnecessary changes. You also need thresholds for action. Define what level of underperformance triggers review. This could be based on drawdown, deviation from expected return, or changes in key variables. These thresholds create discipline. The ability to do nothing is a skill. It requires patience, confidence, and discipline. It is often more difficult than taking action, but it is essential for maintaining consistency. Adaptability is not about constant change, it is about appropriate change. Knowing when to act and when to hold is part of that skill. Learning loops are central to continuous adaptation. A learning loop is a structured process where you observe, analyze, adjust, and repeat. This loop operates continuously throughout your trading career. The first stage is observation. You monitor markets, your trades, and your performance. You collect the data without judgment. This stage is about awareness. The second stage is analysis. You interpret the data. You identify patterns, anomalies, and trends. You ask why certain things are happening. This stage requires critical thinking. The third stage is adjustment. Based on your analysis, you make changes. These changes are deliberate and measured. You do not overhaul everything. You adjust specific elements. The final stage is evaluation. You assess the impact of your changes. Did performance improve? Did risk change? This feeds back into observation and the loop continues. This continuous loop ensures that your approach evolves over time. It prevents stagnation. It also ensures that your adaptations are grounded in evidence. Many traders operate without a learning loop. They repeat the same mistakes. They fail to evolve. Over time, their edge deteriorates. By implementing a structured learning loop, you create a system of continuous improvement. This is the foundation of long-term adaptability. Adaptability also requires an understanding of second-order effects. Markets do not just react to events, they react to expectations of reactions. This creates layers of complexity. For example, a central bank decision may not move the market based on the decision itself, but on how it differs from expectations. The initial reaction may then trigger positioning adjustments, which create further moves. If you focus only on first-order effects, you miss these dynamics. Adaptability requires thinking beyond immediate outcomes. You must anticipate how participants will respond. This is particularly important in crowded trades. When positioning is extreme, even a small change in expectations can trigger significant moves. Adaptability requires awareness of this risk. You must constantly ask, what is priced in, and what happens if expectations are wrong? These questions help you stay aligned with market behavior. Second-order thinking enhances your ability to adapt. It allows you to anticipate shifts rather than react to them. Another layer of adaptability is behavioral adaptation. This refers to how you adjust your own behavior in response to changing conditions. It is not just about strategy. It is about how you operate as a trader. For example, in high-stress environments, decision quality can deteriorate. Adaptability may involve reducing activity, simplifying decisions, or taking breaks. This protects performance. In slower markets, you may need to increase patience and reduce the urge to trade. This prevents overtrading. Behavioral adaptation ensures that your actions remain aligned with your capabilities under different conditions. It recognizes that you are part of the system, not separate from it. This requires self-awareness. You must understand how you respond to different environments. You must recognize when your behavior is becoming suboptimal. Professional traders monitor their own state as closely as they monitor the market. This allows them to adapt not just externally, but internally. Adaptability is also linked to information processing. As markets evolve, the relevance of different information changes. What matters in one regime may be irrelevant in another. For example, in a macro-driven environment, economic data and policy signals dominate. In a technical environment, price structure and flow may be more important. You must adjust your focus accordingly. This does not mean ignoring other information. It means prioritizing what is most relevant. This prioritization enhances clarity. It reduces noise. It allows you to make better decisions. Your framework should define how you weight different types of information. This weighting may change over time. Adaptability requires updating these weights as conditions evolve. Without this adjustment, you risk focusing on irrelevant signals. This leads to poor decisions. Collaboration and external perspectives can also enhance adaptability. No trader has perfect information. External input can provide new insights and challenge assumptions. This does not mean following others blindly. It means using external perspectives as a source of information. You still apply your own framework. Institutional environments benefit from this. Teams share insights. They challenge each other. This improves adaptability. As an individual trader, you can replicate this by engaging with high-quality information sources. You expose yourself to different views. You test them against your framework. This prevents tunnel vision. It ensures that you remain open to new information. Adaptability requires openness, not to everything, but to relevant, high-quality input. Risk management must evolve with adaptability. As conditions change, risk characteristics change. Your risk model must reflect this. For example, correlations may increase during periods of stress. This reduces diversification. Your effective exposure increases. Adaptability requires recognizing this and adjusting. Volatility changes also impact risk. Higher volatility increases the potential for large moves. Your position sizing must reflect this. You must continuously reassess risk. It is not static, it evolves with the market. A rigid risk model can become dangerous. It may expose you to unintended risk. Adaptability ensures that your risk management remains effective. Adaptability also involves recognizing structural breaks. These are significant changes in the market that alter behavior in a lasting way. They are different from normal regime shifts. Examples include major policy changes, technological disruptions, or shifts in market structure. These events can invalidate existing strategies. Recognizing structural breaks early is critical. It allows you to adapt before significant losses occur. This requires awareness of the broader environment. You must look beyond price. You must understand the forces shaping the market. Structural breaks are rare, but when they occur, they are impactful. Adaptability at this level is about survival. Ultimately, adaptability is about alignment. You are aligning your strategy, behavior, and risk with the current market environment. This alignment is dynamic. It changes over time. You are not chasing the market, you are adjusting to it. This requires discipline, structure, and continuous learning. The trader who masters adaptability does not fear change. They expect it. They prepare for it. They use it as an opportunity. This is what allows them to remain consistent in an inconsistent environment. At the highest level, adaptability becomes less about reacting to change and more about anticipating the range of possible environments before they fully materialize. This is where scenario-based thinking becomes essential. Instead of asking what the market is doing right now, you begin asking what it could do next and how your positioning and strategy would respond to each possibility. This approach removes rigidity. You are no longer dependent on a single view. You are prepared for multiple outcomes. Each scenario has a defined response. If volatility expands, you already know how you will adjust size and structure. If liquidity contracts, you already know how your strategy exposure changes. If a trend accelerates, you understand how you scale into strength rather than hesitate. This is not prediction, it is preparation. The distinction is critical. Prediction attempts to be right. Preparation ensures you are ready regardless of outcome. Professional traders build these scenario maps continuously. They define base cases, alternative cases, and tail risks. Each has implications for positioning, risk, and behavior. When the market begins to move in a certain direction, they do not need to think from scratch. They execute within a predefined framework. This reduces decision fatigue, it improves speed, it enhances consistency. Most importantly, it strengthens adaptability because the adjustment process has already been thought through in advance. Without this structure, traders react late. They hesitate, they second guess. By the time they adapt, the opportunity has passed or risk has increased. Scenario-based adaptability is forward-looking. It is strategic rather than reactive. It represents a shift from responding to the market towards operating alongside it. Adaptability also requires an understanding of asymmetry. Not all changes in the market are equal. Some shifts have limited impact. Others create significant opportunity or risk. Your ability to distinguish between these determines how you allocate attention and capital. You must constantly evaluate where asymmetry exists. Where is the potential upside large relative to the downside? Where is the risk elevated relative to the reward? These assessments change as conditions evolve. In stable environments, asymmetry may be limited, opportunities are smaller, and risk is more balanced. In transitional environments, asymmetry increases. Markets can reprice aggressively. This is where adaptability becomes most valuable. However, recognizing asymmetry is not enough. You must also adjust your behavior accordingly. When asymmetry is high, you may increase focus, refine execution, and allocate more capital. When asymmetry is low, you may reduce activity and preserve resources. This dynamic adjustment ensures that you are not treating all market conditions equally. It aligns your effort and risk with the quality of opportunity. Traders who fail to adapt in this way often overtrade in low opportunity environments and underperform in high opportunity ones. This is not a strategy issue, it is an adaptability issue. There is also a temporal dimension to adaptability that is often overlooked. Markets operate across multiple time frames simultaneously. Short-term noise, medium-term trends, and long-term structural forces all interact. Your adaptability must respect this complexity. You cannot focus on a single time frame in isolation. You must understand how they interact and which one is currently dominant. For example, a short-term trend may exist within a larger range. Adapting to the short term without recognizing the broader context can lead to misalignment. Conversely, ignoring short-term dynamics in a fast-moving market can result in missed opportunities or increased risk. You must continuously assess which time frame is driving behavior. This informs your strategy selection, risk management, and expectations. Adaptability at this level requires flexibility in thinking. You are not locked into a single perspective. You shift focus as the market evolves. This is particularly important during transitions. When markets move from one regime to another, the dominant time frame often changes. Recognizing this shift early enhances your ability to adapt effectively. Adaptability is not only about external change, it is also about internal calibration. Your decision-making process must evolve as you gain experience and as market conditions shift. This involves refining your mental models. Early in your development, your models may be simplistic. Over time, they become more nuanced. You incorporate more variables. You understand interactions more deeply. However, complexity must be managed carefully. Overcomplicating your framework can reduce clarity. Adaptability requires balance. Your models must evolve, but they must remain usable. You must also calibrate your confidence. As you gain experience, confidence increases. This is necessary for execution, but it must be balanced with humility. Overconfidence leads to rigidity. It reduces adaptability. Continuous calibration ensures that your internal state remains aligned with reality. It allows you to adjust not just what you do, but how you think. Another advanced aspect of adaptability is recognizing when to step back entirely. There are periods in the market where conditions are unclear, conflicting, or unstable. In these environments, the best decision may be inactivity. This is not weakness, it is discipline. Preserving capital and mental clarity is a form of adaptability. Many traders feel the need to always be active. They equate activity with productivity. This leads to forced trades in suboptimal conditions. Over time, this erodes performance. Professional traders understand that not trading is a decision, it is part of the process. When conditions do not align with their framework, they wait. This requires patience and confidence. It also requires a clear understanding of what constitutes a high-quality opportunity. Adaptability includes knowing when to engage and when to withdraw. Both are equally important. Adaptability is strengthened by diversification of thinking. This does not mean diversifying randomly across strategies. It means developing multiple lenses through which you analyze the market. You may have a macro lens, a technical lens, and a behavioral lens. Each provides a different perspective. When combined, they create a more comprehensive view. As conditions change, the relevance of each lens may shift. Adaptability involves adjusting how much weight you give to each. For example, in a macro-driven environment, fundamental analysis may dominate. In a technical environment, price structure may be more relevant. In highly sentiment-driven markets, behavioral analysis becomes critical. This flexible weighting enhances adaptability. It ensures that you are not relying on a single perspective. However, this must be structured. Without structure, multiple lenses can create confusion. Your framework must define how they interact and how decisions are made. Adaptability also extends to execution. The way you enter, manage, and exit trades must evolve with market conditions. In highly liquid environments, execution may be straightforward. In less liquid conditions, slippage becomes a factor. You may need to adjust order types, timing, and size. Speed of execution may also vary. In fast-moving markets, delays can be costly. In slower markets, patience is more valuable. You must continuously refine your execution process. Small improvements can have a significant impact over time. Execution is often overlooked as a source of adaptability, yet it is where theory meets reality. It is where your strategy is translated into actual trades. Adapting execution ensures that your strategy remains effective in different conditions. Feedback loops become more sophisticated as your adaptability improves. Early on, feedback may be simple. You assess whether trades win or lose. Over time, feedback becomes multidimensional. You analyze not just outcomes but context. You examine how trades performed relative to expectations, how conditions influence results, and how your decisions aligned with your framework. This deeper analysis enhances learning. It allows you to identify subtle changes in the market. It also allows you to refine your adaptations more precisely. You may begin to track metrics such as performance by regime, performance by volatility level, or performance by strategy type. These insights provide a clearer picture of where your edge exists. This level of detail transforms adaptability from reactive adjustment into strategic optimization. Long-term success in trading is not about finding the perfect strategy. It is about building a process that evolves continuously. Adaptability is the mechanism that drives this evolution. Over time, your approach becomes more refined. You eliminate weaknesses. You strengthen strengths. You become more efficient. This process never ends. Markets will continue to change. New participants will enter. New technologies will emerge. Adaptability ensures that you remain relevant. This is what creates longevity. It is not a single breakthrough. It is continuous improvement. Traders who stop evolving eventually fall behind. Their strategies become outdated. Their performance declines. Adaptability prevents this. The professional trader mindset integrates adaptability at every level. It is not an isolated skill. It is embedded in how you think, how you analyze, and how you act. You approach the market with flexibility, but within a structured framework. You are open to change, but disciplined in execution. You are confident in your process, but humble in the face of uncertainty. This balance is what defines mastery. It allows you to navigate complexity without becoming overwhelmed. It allows you to evolve without losing consistency. Adaptability is ultimately about alignment with reality. Markets are dynamic. Your approach must be dynamic. When you achieve this alignment, you create resilience, and resilience is what sustains performance over the long term.